Hey Shane, how's it going?
I'm here, man. I'm here. We're running late today, so we got a lot to cover in a short amount of time. So let's just jump into it. I hope you're doing well. I know you've been running around up in Minnesota. Hope you're staying warm.
I am, so a little chillier, but I got here and it was 75, so that sure felt nice.
Not bad.
But
I'm about to turn on the fan in my office. It's warm in here.
nice. We'll start off. We have this exciting slide up for everybody. So just our legal disclosures. If you'd like to pause that, you can read through it. But let's kick this off. We got GDP this morning and it was positive. Is that right?
They reported a positive number that gives the Fed green light to hike by as much as they want to. And I would expect the Fed to hike by at least 75 basis points next week. But even if they don't hike by 75 basis points Wednesday next week, they'll hike by something. And hiking rates is not bullish. So I wouldn't get too excited about the GDP print. We'll cover that a little bit later in this call. Um, to me, it just gives the Fed a reason to hike, and higher interest rates are going to continue to be bad for asset prices, whether in the S&P 500 or the Nasdaq or in the real economy. So good luck with that.
That's accurate. And I know the last week when we had our meeting, we were looking at the 50% fib retracement level, and I told you I'd put some retirement money to work there. And, you know, I think it's always important to bring it into context here is that, we're going to have some bounces here, so to speak. So we had a few days up here. And while that's nice, what's important here is just when I look 5, 10 years out, or people are looking at that type of time frame, that was a nice spot to put a little money to work where I had all cash. So we're now sitting here. We've had a few days up, but here's what I'm seeing. You got that 50-day moving average right into that. This is a natural spot where we could see it pull back, but I think, maybe we could find our way up to this 200-day, but there's no question we're still in a downward trend and we have not broken out of any real key levels. And I don't see how, positive GDP, like you say, just gives the Fed a green light to hike rates. I don't really view that as everything is all in well. What are your thoughts?
I already gave them to you, man. Every one of these bounces is a good opportunity to sell more stocks if you didn't get out enough already, or if you want to short them. I think this is a good time to add to a short position if you have it, or an inverse ETF if you have it. I don't see any reason to buy this bounce. I didn't see any reason to buy it last week. We're up a little bit from there, but my guess is that we're running into declining moving averages, resistance overhead, and economics are going to dictate a fresh move lower. So, yeah, I just, it's the same story as it's been all year. Not a lot of reasons to be bullish. We don't really, buy the SPY for clients or anything like that. So I don't really have a 10-year time frame either. I mean, there's some individual stocks that look good. We actually bought our first new stock in our growth strategy in 90 days. It's actually 89 days. That's the longest we've ever gone without adding a new stock to our growth strategy. Um, and so, there's pockets out there. There's stuff that looks good, but everything on a tight leash. If you're going to buy something here, you need to keep a tight stop. You need to have a real good reason to buy it. You need to believe that they can grow earnings over the long run. And personally, I do think that a year from now, I don't think we need to even go 10 years. I think that's kind of that's too far. But I think a year from now, I think a lot of stocks that don't go to zero will be higher than they are today. So don't pick any that go to zero. Follow your stops. And it don't if you have the benefit of not having to look at your portfolio in the next month or 2 months or 3 months or 6 months, go ahead and buy stuff. Because a year from now it'll probably be up. But in the next 3 to 6 months, it might be down a lot. Yeah, I mean, it could easily go down 20, 30%, whatever it is that you might be buying, even if it's the S&P 500. So in the short term, I think the market's going lower. In the longer term, certainly bullish on America, and I think the U.S. stock market is the best wealth creation tool in the history of the world. I don't think that's likely to change in the long run. So anyway,
Yeah.
yeah, we can go next slide and get a little zoom in at the run into this 50-day moving average, which is so far acting as resistance. When
Hmm.
I took this screenshot about a half an hour ago, the market was higher than it is now as we're talking. Markets have made a fresh low, bounced a little bit again. But today is today's a big day. We got GDP this morning. We'll have Apple reporting after the bell tonight. We'll have Amazon reporting after the bell tonight. That's 20% of well, the next one we're gonna see. I don't know if you have anything else on here, you can, but
No,
QQQ, Amazon and Apple make up about 20% of the QQQ ETF. So Apple's about 13%, a little over 13%, and Amazon's a little over 6, almost 7%. So about 20% of the ETF is going to be reporting after the bell, and I would expect it to move pretty violently depending on what these two report. I can't imagine they're going to report anything great. Do they beat the lowered expectations? Perhaps. Do they even show a little bit of growth in earnings from a year ago? Possibly, mostly due to inflation would be my guess if they're able to post growth in earnings. But again, a bounce in those maybe just takes it up to the 50-day where you can sell it again. So so yeah, if we were shorting things for clients actively, I'd be looking for an opportunity to sell. I sold more Qs this morning in my personal trading accounts, and so yeah, this is what we're watching. We're definitely not out of the woods by any respect, especially with the Fed going to raise rates next week by any amount. It's going to be bearish for the tech stocks.
yep.
By the way, I thought it
And
was funny. I was looking at the constituents of QQQ the other day, and Pepsi and Costco are in the top 10 holdings of the QQQ trust. Who knew? Everybody talks about it as if it's all technology stocks, but yeah, Pepsi and Costco are in there somehow. I had no idea.
interesting. And something I always think it's good to highlight, this is the broad market. Here we're a little more tech focused, but I think when we take this next move higher, when things do get bullish again, we'll probably have new names leading the charge. And I say that because, Meta, that's been all over the headlines, just got destroyed.
Yeah,
And
they got hit.
it
And
used to
they're
be,
not as much of a as not as big of a constituent in the queues as it used to be.
yeah, but that's one where, if you would have been a buy and hold investor and held on, you had some good years where you're really excited. And now it's all given back. And, you know, just I bring that up because we had the FANG index that was, Facebook, Amazon, Netflix, and Google were leading the charge. And I would not be betting on Meta to lead that charge now. So it's always interesting. You just see that rotation to new names, and those new names can emerge earlier in a bear market. So we'll see what happens. But I think right now, just NASDAQ, same thing. Just no reason to be bullish on any of this right now. So, all right, Apple, Shane.
We don't need to spend a lot of time on this. We looked at it last week, but figured I'd just show you the update. It broke through the downtrend, ran into the 50-day moving average, and now reports earnings after the bell tonight. If it wasn't reporting earnings after the bell tonight, I'd say this is a short right now. Just everything looks like it wants to head lower. So headlines always trump technical analysis. So depending on how the headline comes out tonight, the technical analysis may have to be reset, but I will not be surprised to see this thing drop hard after the earnings report tonight, and make a fresh low. That will not surprise me at all.
Yep.
If it puts up a good number and rises, I think there's still, the 50-day and the 200-day overhead plus the resistance of the connecting the lower highs from earlier in this year. So I think there's a lot of overhead resistance, even if it reports a good number. But if it misses or reports a surprise bad number, this thing can drop really fast because this is the last place that people are hiding out. And don't forget, they already slowed the production of the iPhone 14, which just recently came out. So they're not selling as many of those as they had originally planned on. So who knows? Some say that they're selling more of the Pro versions, which are the more expensive versions. So selling fewer phones, but the higher end version of the phone could lead to higher revenue overall. But we'll find out tonight, and I won't be real surprised if it goes materially lower. I will be surprised if it makes a new high for the year. I don't think that's likely to happen. So
Yep. And when it comes to an earnings report, it's always risk management number one. If you're in front of it, maybe protect something a little bit. But in terms of predicting the earnings report, the best tool you have is a quarter. Take it out, flip heads or tails. I mean, nobody knows where it's going.
No, even if you know, there's evidence to suggest that even if you know what the number is going to be, you still can't make money front
Yeah.
running earnings because you don't know how the market's going to react to them. So there's a study on this. I don't remember the name of it. I could find it for next week or something, but there's a bunch of guys that had inside information. They got caught with it, but their win rate was less than 50%, even though they knew the numbers that were coming out for several years. They knew the numbers ahead of time, and they still couldn't make money trading that. And so they went to prison, I think, for not even really making anything because it's illegal no matter how you slice it.
Yeah. And then Tesla, I think I don't like this chart at all. I don't know
My
what your
favorite
thoughts are on
turd.
it.
No, this thing sucks. I would be shorting it here all day. Got a little buy signal a couple of days ago, the short-term momentum. So if you're a long-term holder and you want to look at the momentum and maybe take a stab here, put in a buy with a stop around the recent lows, maybe around 207 or 200. We have clients that like to buy this kind of stuff in their non-discretionary accounts, the ones that we don't manage for them. So I've been watching this for a couple of people and just letting them know when I get certain buy signals. But I would have ignored that buy signal for myself personally. I'd love nothing more than to watch Tesla go back to like $60, which is a long way down from here. So uh, anyway, yeah, we'll see what happens. But maybe some upside to the 200-day moving average, but I don't like it.
Yeah. And then here's one, Amazon. It's interesting. This is the first time I'm seeing this chart. I know they have earnings, but this is what I see. Came back up to the 50. It's rolling over. It looks like just a big consolidation through here. It's kind of scary. I think for me, I could see this thing moving lower. What are
Yeah,
your
lots
thoughts?
of lots and lots and lots of names bouncing into their declining major moving averages. No surprise here that, when you run into a declining moving average from below, it's likely to reject. I mean, that's just until these things get above these major moving averages, and then the moving averages start actually trending higher. There's just not a lot of reason to get too aggressive on the buy side. You don't have to pick bottoms in order to make a lot of money in the next bull market that develops. And there's really no reason to front run the Fed or try and guess at when the Fed is going to stop hiking rates or pivot. They're not going to pivot to cutting rates anytime soon. So again, I mean, it's like picking up pennies in front of a freight train. Doesn't make any
Hmm.
sense. What do you
No.
know? Another
And
another stock that ran into its declining 50-day moving average and got severely rejected. So this is Alphabet. Still has the ticker Google, and that gap down from the 50-day moving average into yesterday was pretty significant, and then has moved even lower today on an earnings miss, lower ad sales, just nothing good in the report. And now we're breaking down below levels we haven't seen, since early 2021. So yeah, I wouldn't want to have a big aggressively long position in this one, and might even be stopping out if you have a long position in that here, and just looking for a new entry point when it finally shows some momentum to the upside, above the 50-day and 200-day moving averages. So nothing good happening here either.
no, and this is part of, I talked about it before, but where with XLE, it's nice is usually when you have a nice clean uptrend, those are great. But this is the risk you have trying to pick bottoms is you get this rally into the 50. And trust me, I'm sure people were getting excited down here and thinking this is it. And then your hopes just get crushed right here. And,
Dude, and
who
Google's down
knows?
30%. It's down from its highs earlier this year that it hit in February. It's down 37%. Microsoft, which you've got on the screen now, is down 34% from its highs in November. At the lows at 219.13, it was down 37% also. It also gapped down on its earnings. Remember, Microsoft just laid off 1,000 people, so they're not doing very well. Amazon actually froze hiring in a couple of places, and they're hiring less people for the holidays than they have in past years. If I remember right, that you might want to check that one, but I think that's the case. And so again, there's not a lot of fundamental reasons to be long any of this stuff, and there certainly aren't any technical reasons to be long any of this stuff. So
No.
some of the best stocks, I mean, these are great companies. They're not going to zero. I'm not worried about any of that, but you don't want to own them right now. Not certainly not aggressively, right? Like if you try to catch Microsoft or catch Google at the lows in the past couple of months, hopefully you only took a partial position, and hopefully you've got a real tight stop where, if this thing drops and closes below the recent lows, you would take your hit and look for a new entry sometime down the road. That's how you know that's how you, instead of picking bottoms, that's how you inch into a position during the bottoming process.
Mm-hmm.
So bottoming is a process, not an event. This could be the beginning of the bottoming process. This could be the midpoint of the bottoming process, or this could be the end of the bottoming process. You don't know until it's happened. So it's not like you can't take any chances. But when you take your chances, you want to control the risk, control your position size, and honor your stops if you hit them. Don't listen to your gut. Don't say, oh, it'll come back, because yeah, it'll come back, but it might drop 30% first.
Yeah.
So
And it's funny is these tech companies, these are the biggest names you can think of. If I wanted it the best company ever, I would have bought these. But if we go to 1930, you know what the biggest tech company was?
US Steel.
RCA.
Oh yeah.
Do you see them around anymore?
Nope.
And
Nope.
that's just it, is that some of these names in Microsoft, like I said, great company and they've done really well, but there's nothing saying this can't go to zero. So it's always good to manage that risk and don't pick the bottoms. Just let the market tell you when it's time to get in.
Yeah, I mean, you got a lot of time.
Yeah. So, and here's Meta. I I don't know what you want to talk about on this one, but man, just showing you that it can still go lower.
Yeah, we'll just look at these gaps. I mean, someday these gaps might get filled. Usually that's how technical analysis would work. So, the most recent gap was yesterday, from earnings down to where we're trading now. And maybe the stock will climb and fill that space, right? That dead space. So overnight, Meta dropped 22, 23%. And so, it now has to claw that back over some amount of time. You can see though the earnings report, 4 earnings ago, when it had the bigger gap down, from the 50-day moving average. Yeah, that whole area. I mean, that still hasn't been covered yet. Someday,
Hmm.
maybe it will. That might take a decade. It might take 5 years. It might happen, next earnings report. They could report some type of surprise revenue that blows everybody's mind, and the stock will gap up overnight and open way higher than where it closed. So you never know. But there's a couple of different, long-term downtrends intact here for Meta. And I personally, we tried to buy this stock for clients back in December, January. It was very cheap, by any fundamental valuation standard. And the problem is I was looking at it and saying, hey, look, Facebook's got a great business. It's super capital efficient. It doesn't have to spend money to continue earning. Like, it just looked really cheap. But the problem is I was fooled and was looking at earnings that weren't real, that weren't going to continue. Since then, earnings have done nothing but drop. Their capital spending has done nothing but rise. So I thought they were capital efficient, but they turned out to be spending a lot of money on this metaverse nonsense. And on top of that, their earnings just declined. So Meta was way more expensive than the fundamentals would have indicated. And I'm glad we stopped out, and I'm glad we don't own it anymore. Things down, I think, 40% since we closed it. And it's down, gosh, what is this thing down for the year now? It's got to be, I think it was over 60% when they reported. So from the highs in September of last year, Meta is now down 73%. And this is one of the biggest companies in the world. So again, Microsoft probably isn't going to zero. I know you said that it could. Certainly anything's possible, but it's not like it can't go down 70%. I mean, if I had told you a year ago in September of 2021 that Facebook was about to drop 73%, you would have laughed me out of the room.
You bet.
Nobody thinks it's possible. And then we look at this stuff and it's like, holy crap, that thing got smoked.
Hmm.
And it continues to get smoked. Every bounce that you see on this chart, right? Like, some of these bounces in Meta are like 23% to the upside. Is that first bounce after the big gap down. The second bounce was 30% to the upside. After that, it went up 17% to the upside. I mean, and every single one of those bounces was just an opportunity to sell. That's it.
Yeah.
That's all it was. So yeah, don't get too excited about bounces, no matter where you see them in the market, and don't think you can hide out in a company that's historically been good and trades at a good valuation, and is just a big stalwart and a big component of an index. Like, you can't hide in these names.
Nope.
Anything can happen at any time. So that includes Apple and Amazon that report after the bell. I mean, they could gap down just like this on if the market gets surprised by a bad print, look out below.
Yep. So then, turning over to commodities, natural gas, man, it has been something, right? It was up to, I don't know if it officially hit $10. I mean, or no, it looks like you highlighted it, so
Yeah, it did.
$10. And
It did on this chart. 1004.
yeah, and I mean, with all the headlines, everything else, all I could see on this too, I'm guilty of it. I thought this is going to the moon. And boy, talk about volatility. We're back down to $5, so down 50%.
Yeah, 100% gains to the top end of the range here if you want to mess with it. I personally tried to grab this thing a couple days ago, and I stopped out this morning, thankfully. But I think we will probably get a bounce from here. I mean, you can see the green box has kind of been, resistance and support a couple of different times now. I don't have the 50 and 200-day moving averages on here. I accidentally took them off, but yeah, it's it looks pretty ugly, but sometimes if you want to gamble, you can take a shot at something like this with a small amount of money. And I think we'll probably go higher into the end of the year, but I don't know if we'll get quite back to $10. So it's been super volatile. They don't call it the Widowmaker for nothing.
Yeah. And I think what's important on this one is just when we're talking about inflation over in Europe, driving higher energy costs here in the US, this will provide some relief, so that's good. But just in terms of a chart or anything to invest in, it is the definition of volatile, and that is why they call it the Widowmaker. So it's manage risk best you can, but all over. So this one, so 60/40 portfolio, we highlight this each time, but just proving that correlation from the past does not always play out in the future. Bonds are down, stocks are down, really no protection offered by bonds at this point.
Yeah, if your advisor has you fully invested in a 60/40 portfolio, please call us. There's a better way, I promise. You're getting smoked this year and you shouldn't be.
Yep. So this one, so Shane, I like to trade crude oil, and this is one where love this chart. So I saw it come down here. It started hooking again. This is about a 50% retracement off of that recent rise, and it's kind of trying to work its way back up through those averages. I don't understand the fundamentals on why this all comes to be, but I know one sector that we'll talk about stands to benefit greatly from this. What are you seeing here?
Yeah, I mean, last week when we talked, it had just been rejected by the 50-day moving average, but was holding above that purple trend line. So it was
Yeah,
kind
I
of in
think
no man's land. But now it's definitely broken through the 50-day moving average, and we got a little bit more overhead resistance. But if this thing really breaks out and goes back to 100, oh boy, the next chart you see will be much, much higher.
and some interesting so I was listening to Macro Voices podcast, and they were talking on there with one of the guys, spends a lot more time than we're able to researching one thing in particular. And they were talking about crude oil, and it's interesting is China's been on lockdown still. And if that reopened, what would that do to the demand side on crude oil? And I have absolutely no idea where that goes, but I just thought that was an interesting thought to talk about. I never really factored that in as much.
Yeah, I mean, I don't know if I would. Don't you think they'd just buy it from Russia? Since Russia has to discount their oil in order to get it sold right now, given all the different boycotts and sanctions and so on. I think they probably have a ready and willing supplier at a lower price that probably
Hmm.
won't impact the price of West Texas, WTI. I don't know. I don't know that matters.
Yeah, but
Um, personally, but maybe I'm wrong. I mean, I don't know. I don't know.
yeah,
Maybe that would mean the other people who are currently buying Russian oil and dodging sanctions would have to buy it, from in the world market instead. So
yeah,
you never know. But yeah, it is true that China is still, I don't know, still worried about that COVID thing for some reason I will never understand.
Yeah, but what I do see and what I understand is technicals, and this is a level right here. We get back over 94. Man, that thing could really start going, but it looks really constructive right now. And that brings us to my favorite chart right now if we're talking about stocks. I mean,
Yeah,
XLE is just following textbook, consolidation, breakout, come back, retest it, and it just seems like it wants to go up.
thing's insane, man. It's I'm glad we've held on to it all year. The funny thing is, man, is like it's up 30% in the past 23 days. Crude oil is up 16% in the last 23 days for comparison. I
Hmm.
mean, think about that. That's pretty wild. And crude oil year to date is up 17%. XLE is up 61%. So again, I don't know why people waste their time trading crude oil when you could buy this stuff. This looks like a much better thing to me, but XLE has options. You can short it, you can long it, you can buy puts and calls and sell puts and calls. And I don't know. I just would much rather trade the the companies that produce and sell the commodity than the commodity itself. And so far that's been a good way to go this year. And next stop for XLE is probably this 93.31 level, which has been the high for the year and high for the cycle. And I don't know if it'll break straight through that on its own without a little bit of a pullback, regardless of what oil does. But hey, anything's possible, man. I mean, XLE, the energy producers, they're cheap fundamentally, and they have all the momentum. So, um, that's what people want to buy, and there's a lot of demand. So I think this is a good place to have a long position in this kind of market, and eventually that'll change. But until this thing drops below 65, I wouldn't worry too much about it. I mean, if you're buying here, 65 is a long way down, right? So
Hmm.
I mean, that's a 30% drop, 27% drop roughly. So, you got to be careful if you're going to buy here and use a stop all the way down at 65. It kind of limits how much money you can really put into the position. Um, but that said, if you don't own any XLE, I'd be looking to buy it on any type of pullback, to the 50-day moving average or something like that. So,
Yep.
yeah, the trend looks good. The 50-day and the 200-day are both going higher. It's like the only uptrend in the market.
Yep. And this is one too that not so long ago, oil was negative. So they're coming from pretty cheap valuation and working their way up the ladder. So,
Yep.
but, and now Shane, I texted you about this the other day. I'm not a crypto guy. Not that I don't believe in it. I just don't trade it because I don't know it as well. But this chart, we've been talking about this in here that keep an eye out. It's, potentially building a base. And man, that right there, I saw that. I don't know what percentage that was up, 10% or something over 2 days, but that looks like a really nice breakout. And I think if it can come back retest successfully and work its way higher, crypto might be in vogue again. But what are your thoughts here?
Yeah, I bought some. Nothing crazy. It's it's not up very much, but it is definitely making a higher high after making kind of a higher low. And trading above the 50-day moving average. 50-day moving average is moving higher. We had that happen back in like August as well. So I mean, there's no guarantee here that it doesn't ultimately drop and go lower. Could just be a fake out before it breaks down and drops back towards that 17,500 level. But yeah, I bought a little tiny bit of crypto for the first time in a long time. I think since July was the last time I did this, and I put my stop at 17.5. So if that's like a 13% or 10% drop from where I bought it, I think. And so we'll see. As long as it holds 17,500, I'm constructive on Bitcoin, and I even bought some Ethereum too. It looks a little bit stronger, I think, overall. I
Hmm.
don't have a chart for that here, but feel free to go check it out at Coinbase or wherever you trade your crypto. And yeah, I mean, there's some ways to buy this in markets, and we'll keep an eye on it when it comes to Elevate clients. I have no problem putting Bitcoin into the growth strategy. There's a few different instruments, a few different ways that we can do that now, and I'm looking forward to doing it when the time comes. So it's going to remain a volatile asset though, so it'll limit how much we can actually put in, and got to be careful about where you put your stop. But I definitely think Bitcoin can go much higher in the long run, even if, just like I said earlier, it could also drop 30 or 40% further in the short run. So, but a year from now, my guess is that Bitcoin is, substantially higher than where it trades today. That's my guess.
Yeah. And I think tend to agree. And like you said, I really like the chart on Ethereum. I don't understand the fundamentals enough to know why one's better than the other, but that was a nice looking chart. So, and now, Shane, is this the line in the sand getting broken, or is this to be determined? I mean, here's the 10-year. It's been just outstanding, but man, it's been on a tear. And now
Yeah.
it looks like we're maybe going to close under this trend line. We have a little bit of a negative divergence there on momentum. What are you seeing?
See what you just highlighted. I mean, we broke the line for the first time since August. You know, the dollar dropped from June till August while the market was doing its bear market rally, rising 20% during that time, from like mid-June until the beginning of August. The dollar was down 27%, and the market was up about 20%. So could be time for another extended breather in the dollar, which wouldn't surprise me. The European Central Bank raised rates by 75 basis points today. So as Europe raises rates, it'll definitely kind of hit the dollar a little bit harder. You also have Japan intervening in markets. You also have so the Japan was looking to protect the yen, which is a nice chunk of the basket that the dollar is compared against to get these values, and so they're trying to protect their currency. So they went and bought lots of yen to support it, and as the yen goes higher, that puts pressure on the dollar. You also had some guys in China selling the crap out of dollars to protect their economy, which was kind of like in crash mode last week. So as they sell dollars, that puts more pressure on the dollar, right? So you had two sources of pressure last week, and then today you got the ECB raising rates ahead of the Fed raising rates next week. So it'll take a minute for that to kind of work itself out. And in the meantime, the dollar could certainly break lower, down to that 50-day moving average area, or even lower. I mean, there's no reason that it can't go even lower than that. But yeah, there's definitely cause for concern here on the 10-year yield. Again, the dollar really impacts the 10-year yield, and so that's to me, that's what it's all about, is the moves in the dollar have caused this to pull back. Plus you get these people in the United States calling for the Fed to pivot to cutting rates, which is not going to happen anytime soon. So I mean, there's a few different headwinds for the dollar, but it's been on a tear. The 10-year yield has been on a tear, so I hope you took advantage and bought at least some short-term treasuries during this meteoric rise. And we'll get to a dollar chart too in a minute. But the 10-year yield and the dollar are very tightly linked.
Yep. And this one, I don't think we need to hit it too hard. We've talked about this one pretty extensively, but the inverted yield curve continues to pose risks to the underlying economy and pretty good predictor of recession.
Yep. Every time it's dipped below the red line, you see a white box follow it pretty shortly after. So I don't think this time will be any different. I think we're probably already in a recession, despite the fact that GDP printed positive this morning. So yeah, no reason to stay on this one. We can move on to the
And
dollar.
yeah, to the dollar. See, you mentioned it here, but this one, look, we did get under this low
Yep.
recently, bounced there, which that's normal. You're not going to move straight down. If it breaks that trend line, that's where, I see that as a big relief to equities, and that would be a positive.
Yep.
But right now, it's too early to call. So still up 15% this year.
Yeah, it's the first lower high we've gotten in a while. So, just a period of consolidation is most likely, as long as the Fed keeps raising rates. I think that'll put support underneath the dollar. It's still up 15% for the year, which is much better than inflation. So I think, I think we're kind of in a holding pattern here to see which way it breaks, up or down. But
Hmm.
yeah, a break lower will definitely send stocks higher. So something worth keeping an eye on. And of course, if it breaks higher, that'll be bad for stocks. So
Yep.
we'll see.
And then this one, we highlighted this last time. It looks like that could invalidate the resistance we're looking at, but it's much too early to tell. I mean, this is within today's trading action, but it is just looking like a kind of big triangle formation right there, a little consolidation, getting ready to go down on copper.
Yeah, it could be a
But
false breakout. And then it moves lower. I've seen that pattern more times than I can count in my trading career. So we'll see what happens here. But if copper breaks higher, that would also be bullish for the market overall. Dr.
mhm,
Copper tends to lead the market. And so, the economy has changed since Dr. Copper was like the key indicator, but I think it's still pretty important. So we'll keep our eye on copper. If it breaks higher, market can break higher. And if it breaks lower, then market can easily go much lower too.
yep. All
Mortgage
right.
rates finally
Ouch.
eclipsed 7%. You can go one more. So 6.63% was the high during the recession 2008, 2009.
Yep. So 7%, that is not pretty. I would not be wanting to buy a house with a rate like that.
No, we didn't practice, so Kyle doesn't know there's more
Nice.
animations to come. So we're obviously above that now. One
Nope.
more highlights the 7.08% that we're seeing. So finally did break above that 7% level. Seems to be holding steady up there. And I don't know, the next stop was like, it started with an 8. I can't remember exactly what it was, but the next level on my charts, if it holds up above 7, is materially higher again. So that'll bring house prices down, which will bring inflation down. So we'll see how it plays out, but definitely want to keep our eye on mortgage rates.
Yep. And this one, just real quick, talk about this all the time, but within a bear market, you're going to see these big rallies that happen. Does
Just like
not
in
mean,
Facebook.
yep, does not mean it's the bottom. So just something to be mindful of.
In a bear market, you look for selling opportunities.
Yep. And this one, another chart we've talked about at length, simply the Fed's going to have to raise rates until it gets to a real rate of return, so a little higher than inflation. And it looks like April 23 on this table kind of highlights it. You can go back and look at other ones for some of the scenarios.
Go forward. Next. So this is showing CPI growing by 30. Whoa, settle down. One at a time. Shows CPI growing by 33 basis points month over month, which is equivalent to 4% per year. You can see in the CPI column, even if CPI grows by 33 basis points month over month, the annual rate of CPI will still be declining by some amount. So again, we're looking into the month over month inflation rate and then letting the annual year over year inflation rate just be whatever it's going to be based on that. So um, in this scenario, we see CPI dropping to 5.1% by April of 2023, and if the Fed hikes the way that we think they will, another 75 basis points next month on the 2nd of November, so next week. And then 50 basis points in December, 25 basis points in January, another 25 basis points in March. This is the rate increase column, the second column, where you see our projected Fed rate hikes. Kyle is not putting his mouse over it though for some reason. I think he's asleep over there. No, wrong column. Rate increase column. Second
There we
one
go.
from the
Yep.
left. There you go. So that's where you see the anticipated Fed rate increases. And then if you subtract the Fed funds midpoint range, actually subtract the Fed fund from CPI, you get either a positive or negative number. And so we don't think they're likely to stop until they get to a positive real rate. And it looks like that could happen in April of 2023. If you go ahead and go forward one more. The problem here is that CPI levels out at 4% a year, which is double the Fed's current goal of 2% per year. So in this scenario, they might stop hiking rates in April only to resume hiking rates sometime later in 2023 if they maintain the 2% inflation target. They could also decide to raise their inflation target to 4% or something higher than 2% because they don't think they can actually achieve that goal anymore. So that wouldn't surprise me in the least. But as of right now, I see the Fed hiking at least until April. And then from there, we'll see what happens. So could be earlier, right? CPI could decline between now and April. It could grow by less than 33 basis points. It could grow by more. So we'll keep our eye on that. But for right now, April 2023 is my best guess.
Yep. And something too that plays into CPI is energy. So as we're seeing crude oil potentially going back to, $100 a barrel, that could really weigh on that.
Yeah, I wonder how nat gas will impact that as it's
Oh,
crashed from its highs.
yep. So, and Shane, you brought in this Wall Street Journal article. Um,
Yeah,
what are your,
you went too fast on the animations that time. You already got it in here. But ultimately, this is from the Wall Street Journal, and this is all the rage in the market. This is why the market's bouncing right now, is because some officials have begun signaling their desire both to slow down the pace of increases soon and stop raising rates early next year. So April would qualify for early next year, in my opinion. And I don't, slowing down the pace of increases is not bullish. I don't care what you say. Raising rates by 25 basis points is not a bullish thing. Is it incrementally less bearish? Sure, but it's not a real good reason to go buy stocks.
mhm.
So this is what the market is keying on. They're praying for the Fed to pivot to bail them out of their poor portfolio allocations and their downtrending performance. And so everybody's begging the Fed to start cutting interest rates again, which of course will just reaccelerate inflation. So if they cut rates before they get to a positive real Fed funds rate, inflation is just going to reaccelerate, and it's going to be a big problem for everyone in the longer run. So I don't think there's any chance that they'll stop, before it's time to stop. I think they'll probably go too far in hiking rates and cause a massive recession. I think that's more likely. But who knows? But I just thought this was interesting that, every financial media, every financial market watcher and economist, they're all just begging for the Fed to pivot and start cutting rates. And I just think it's so short-sighted.
I agree on that one. So let's see the dot plot. So I don't know if you want to talk through this, working on the animation here.
Yeah, well, I was
But
going to read that first, so just settle down. So at the end of last year, we showed a peak rate of 2.1%. When we saw the first rate hike in March, the estimate climbed to 2.8%. Now it's risen all the way to 4.6%. At the end of last year. Oh, sorry. So that's on there twice. I don't know how that got on there twice. Go ahead. So you can ignore the second paragraph there. And now we got all the way up to 5%, is what it looks like on this chart. So that's where they think the Fed is going to stop raising rates. That's what terminal Fed funds rate is the point at which we stop raising interest rates, which was very close to what I had in the couple charts ago. So go on to the next. And there you have it. If we go all the way to 5%, that quickly, look at how fast that hike cycle is going to be compared to history. So this is where they get off saying that they're raising rates aggressively. I don't really know. They haven't hiked by 100 basis points yet in a meeting, so it doesn't seem that aggressive to me. But they want to toot their own horn and act like, this is some type of aggressive hike cycle. I don't know. Doesn't seem aggressive enough to me. We could have been done with inflation by now if they had actually hiked aggressively. But comparing these two charts, it's just funny. Like on the left-hand side, you see what they thought the terminal rate hike cycle was going to be, and you see how it has changed over time.
mhm.
So from, September of 2022 through 1 year later, like everybody has raised their expectations for how high rates could go because they were never aggressive enough to begin with. So just interesting, the kind of juxtaposition between those two things. And ultimately, if rates go to 5% on the Fed funds, I don't care how quickly or how slowly they get there, it's not bullish for stocks. So
No.
they're going to keep raising, and that's going to keep the stock market, keep a lid on the stock market overall. All right, so we got the PMI data the other day, and it shows that economic growth is slowing, right? So manufacturing new orders both fell into contraction territory, which is below 50 on the PMI. So contraction territory means that the Fed could use that as a reason to stop or slow their hike cycle, but they don't have to. So you can go on forward and see the chart here. You can see that the blue line doesn't spend a whole lot of time below zero, which shows, a contraction. So there you go. That is one reason that the market is, praying for the Fed to slow rate hikes, is because we're actually seeing the economy contract finally. And so, sorry, zero, by the way, is on the right-hand side. That shows GDP. The gray boxes. On the left axis, you see the PMI, which is 50. So 0 GDP and 50 PMI are equivalent in this case. And you can see how they kind of track each other. And so it's interesting that PMI came in again, below 50, and GDP had a surprise positive print this morning.
Yep. It's definitely starting to slow down, but we'll see when they stop hiking. But yeah, this one seems like a pretty big number when I look back across the chart. How does this kind of play in?
So even though you see a whole bunch of companies beating their earnings expectations, they are making less money than they did last year. In fact, all the communication sector is making 24% less profits than they made in quarter three of 2022 so far, based on the earnings reports this quarter. So, and that's the second quarter in a row of declining profits. So there's already a recession in, earnings. And so that communications is just the worst part of it. That includes Google, and that includes Facebook or Meta. That includes Snapchat, I believe. So a whole bunch of companies in the communications sector are making a lot less money than they were this time last year.
Yeah.
In fact, they're making they didn't even, the earnings declined by a peak of 18.5% during the financial crisis. And 25.8% back in, the dot-com bubble crash. So we're every bit as bad as that and worse than the financial crisis. So everything is not honky-dory in earnings land. Even though they're beating these lowered expectations, they're reporting profit declines, not profit growth. That's bad.
Yeah. And then here's GDP. So looks, we're showing this positive one. And I gotta say, I'm looking at this, those negative ones look pretty small.
And that's because the giant bars in quarter two and quarter three of 2020 take everything out of scale. So if you go ahead and go to the next slide, there you go. Now you can see a little better.
Yeah.
So those bars have a little bit more power to them now. And go ahead forward one more. So again, the quarter three positive print in GDP did nothing but give the Fed a green light to hike rates by as much as they want to, because they don't feel like they're going to cause a recession by hiking rates. So why wouldn't they hike rates? Their goal is to get inflation under control without causing a recession. And boy, if the GDP is growing by 2.6% last quarter, why would they stop or slow hiking rates? They won't. I don't see it happening. I think they're going to raise by 75 basis points next week, on Wednesday. So we'll know by the time we get on this call again on Thursday of next week, and I'll either be right or wrong. But I think they go by at least 75 basis points, and I think they can go by 100 basis points if they want to. I don't think they will, but I wish they would.
I agree. And it's interesting. So I'm just thinking about my career, and it's always been when the Fed had a meeting, the market rallied. But once we started seeing this inflation, it seems like every time they hold a meeting, we see a dramatic sell-off. So I'm not going to predict next week, but will they buck that trend? I'd be surprised if they did. Seems that we're rallying up in front of it.
And if the market rallies into it, it's all the more likely that it's going to drop on whatever they do.
Yep.
So let them rally it. That'll be fun.
So Shane, here's the GDP report, and This is a big change right here on the imports.
Yeah,
Did you have
something
any
happened with
takeaways
the
from that?
animations. Go one forward here. So at the bottom, you can see GDP is calculated as private consumption spending plus investments plus government spending plus exports minus imports. So imports is normally a positive number. Look at row 19, which is highlighted. It's not very often a negative number. And all through 2020, it was negative because everything else was negative. um that was, it wasn't like all the other numbers were positive and then, oh, we happen to import less stuff. The United States is a net importer of things. Like, that's generally what we do. We usually at least import a lot, at least as much as we export, right? So if you look at this, this if minus a negative number, you change those to plus a positive, right? And if you're going back to math class, so minus a negative number adds that 6.9% to GDP that wouldn't otherwise be there. um, and I spent a little bit of time messing around with the calculation to figure out what GDP would have been without that 6.9%. Unfortunately, we had to get started before I got to the bottom of it. But my guess is that GDP would have been negative if that number was just flat, for example. Um, so the best part about the GDP being, a positive number this morning when it came out is that it probably is an anomaly, related to this import export imbalance and not an actual indicator of economic strength. And so the Fed, depending on how closely they look into this, they might hike, with reckless abandon based on the fact that GDP was positive, only to find out that it's kind of an anomaly that, if you look up at the top, line 2, right, and compare line 2 to line 19, you see most of the time when line 2 is positive, line 19 is positive. And when line 19 is negative, it's usually because line 2 is negative, right? Personal consumption expenditures, if those are a negative number, then of course we need to import less stuff from China and abroad for those people to buy. Like, they're consuming less stuff, so there's less imports coming into the country. Makes perfect sense. This month, personal consumption expenditures increased, but imports decreased. You know what that tells me? Stuff cost a lot more. So we're importing a lot less stuff, but spending even more money on the stuff that is here. That's probably not a good thing, but I don't know how closely the Fed will look at that before just deciding to go ahead and raise rates.
Yeah,
And let them, because I want inflation to come down, and I think it's better to rip the Band-Aid off than, just slowly bleed to death. So anyway, maybe that was a bad analogy, but at the end of the day, I think the GDP positive number this morning was a bit of a joke, and I think the Fed's going to hike rates. So
I agree.
these got a little out of order on me. This one was supposed to go right after the communications earnings. If you want to go ahead, this looks. This is all of the earnings growth reported by the S&P 500 sectors. So if you want to go one forward, Kyle. So all companies, 189 out of 500 had reported as of, I guess, last night when this was created. Go ahead, one more. And those 189 out of 500 S&P 500 companies reported earnings growth of negative 3.29%. So that is not growth, that is decline. So earnings are not growing, they are declining. And I think that's important. You can that 3.29% negative earnings growth, by the way, includes energy. Look at energy. How much is energy earnings growing this year, Kyle?
195%.
Yeah, yeah. So even though energy is crushing it, overall, earnings growth is down, and the communication sector is there at that 24%, which we looked at earlier. Materials down even more, 35%. So across the board, down. Earnings are, everybody's beating. You go look at all of the headlines and you'll see that this company beat its earnings estimate, and it beat this and beat that and beat this and beat that. Well, it's beating really low expectations. And here's the funny thing is, if you look at the left side of that chart, sales are actually growing by 9.5%. No surprise. Inflation is up, 8%. So
Hmm.
that accounts for most of the sales growth right there. Organically, sales are probably only growing by 1%. And because everything costs more, all the companies are making less in profits because their costs have gone up faster than their sales. Pretty simple. Um, to me, that indicates that the economy is probably in a recession, probably has been in a recession, and hiking rates further is not going to help the situation. So, anyway, that'll just bring down sales. It'll bring down cost eventually, but it'll bring down sales as well. So anyway, not a lot to get excited about there. I wouldn't get too excited about the headline, beating of expectations because the
Yeah.
expectations are terrible. And finally, a reason to be bullish. So Barron sent out a survey, and as you can see, going back to 2000, we are at the second highest level of the percent of professional advisors, the big money poll, who are bearish. And so, again, I feel like we should put some reasons to be bullish into these things every now and then, despite our bearishness, because we could be wrong, and this could be the time to be going whole hog and buying everything that you see. I don't think it is, but it could be. We could be wrong. I'm wrong a lot. So based on this measure alone, right, you want to be contrarian when you get to the point where more people are bearish than ever before, or the second most bearish they've ever been in the past 22 years, a little bit more than that, 25 years it looks like. You might want to think about buying. So these guys, Stansberry, they do some pretty good work. And if you go forward one, Kyle, find out that we've only seen 4 other bearish readings greater than 25% since the data began in the 1990s. And in each case, it was a good time to buy stocks. So this shows you the 3-month, 6-month, and 1-year returns of the S&P 500 after this reading. And so over 3 months, you'd be up about 3.9% versus all 3-month periods for the S&P 500 only up 1%. So that's 4 times better. In 6 months, if you bought 6 months after this extreme reading, you'd be up 5%. And if you bought after this extreme reading after 1 year, you'd be up 16.8% versus only 4%. The market's literally only up 4% annualized since the late 90s. Not a very good decade or couple of decades for the market. So you have to be careful. The sample size is not that big, but 100% of the time during the sample, the market was higher 1 year later. So I said that earlier. I said, a year from now, I think pretty much every stock that doesn't go to zero is going to be higher. So the trick is to, if you don't have to look for a year, it might be a good time to go put some money to work.
Yep.
And you just want to pick your spots and find companies that you think you can stay in that won't stop you out in the next 3 to 6 months while the Fed continues to hike rates. So one reason to be bullish over the longer term.
That is right.
All right, we're going to wrap this
So,
up here pretty quick, but what this one shows, so they changed Fang to Manta. This is Jesse Felder. He does great research as well. But you can see that the aggregate price to free cash flow for the big companies it went up with the Fed printing money. So the Fed printing money is responsible for the vast majority of the rise in stock prices and valuations, especially during the last year in 2021. And so, what I've highlighted here is that if you put the market caps together of Microsoft, Apple, Nvidia, Tesla, and Amazon, and compare that figure with their aggregate free cash flow, you get a multiple of over 50 times, which is down from almost 70 times at the start of this year. That's crazy. Paying 50 times cash flow for a business. That's just insanely expensive after dropping as much as they have dropped. So 70 was even more expensive, but they're still crazy expensive at 50 times.
mhm.
So this reversion in valuations has only just begun. If the Fed continues to decrease its balance sheet at the projected levels, these things are going to literally get cut in half from their current levels, which is a long ways down. So something to be a little bit mindful of. As long as the Fed keeps hiking rates and letting their balance sheet roll off, there's no real good reason for the market to move higher. So that's why we're paying such close attention to what the Fed's doing.
Yep.
Not the B says that if the Phillies win the World Series, we're gonna have a financial crisis. Essentially, I have no idea. Is the World Series over? I don't even know. I don't watch baseball.
I don't watch it, but think we're really close.
Yeah,
So,
I don't
but
know. Phillies, Astros. Nope, they're playing. Oh, game one is tomorrow at 8
okay.
o'clock. So we're just getting started. So I guess this is timely. So pretty much everybody who wants the market to go up is an Astros fan for the next couple of weeks. So get out your rally caps, ladies and gentlemen.
You bet.
And we had nothing from the B.
No B.
The B had nothing but political BS, and this isn't a political podcast, so we'll stay out of that. Nothing economic related. Not even anything to make fun of Biden about, which we can make fun of the president without being political. Everybody makes fun of the president, regardless of what party they're from. So anyway, nothing from the B this time. But sorry for the long-winded chat, but lots of good content and stuff to go through. Could have spent a lot more time on it. And so if this talk or any of the slides generated questions for you guys, we'd love to hear them. We like to hear from you guys out there. It gives us new and better things to talk about that are more relevant to what you guys are interested in for the upcoming week. So please like and share and subscribe and submit questions. And let us know if you'd like to join this live. We've been kicking around the idea of maybe going live on YouTube and having some people join in the chat and be able to ask questions on the fly as we move along. So haven't decided one way or the other yet, but it'd be nice to know what y'all think about that. And obviously the replays would still get posted when we're done. So anyway, that's all I got, Kyle. Anything else to wrap up?
That's all I've got. So thanks again, and we'll see what next week brings, but always exciting with the Fed coming up. So we'll see.
All right, markets looks like it's going to move to the downside as we hang up. So take it easy and happy trading.
You too.